If you've ever felt overwhelmed by the stock market, like it's a mysterious game, only the rich or lucky know how to win, you're not alone. The truth is, most people jump in without a plan, hoping for quick gains and panicking at the first dip. But what if I told you there's a smarter, calmer, and far more effective way to invest on that legendary investor Peter Lynch used to beat the market for years? Lynch didn't rely on flashy predictions or insider tips. He focused on understanding stocks, spotting opportunities others missed, and sticking to strategies that actually worked. He believed that with the right mindset, anyone you could master long-term stock investing and grow wealth over time. His wisdom still rings true today, especially in a world full of noise, fear, and financial confusion. So in this video, we're diving deep into the timeless lessons of Peter Lynch. From navigating market downturns to spotting real buying opportunities, you'll learn how to approach investing with clarity, confidence, and strategy. Ready to stop guessing and start investing like the greats? Let's go! If you really want to start transforming your financial life, the key is to keep it simple. No need to complicate things. I've left a link in the first pinned comment below. Click there and find out how to take your first step. Believe me, you'll be rewarded with everything you need to achieve success. Before you invest a single dollar in the stock market, ask yourself one simple question. Do I really understand what I own? Peter Lynch was famous for saying that people would spend more time researching a toaster than a stock, and he wasn't joking. Understanding stocks means going beyond the ticker symbol. You need to know what the company does, how it makes money, and what drives its success. If you can't explain that in a few clear sentences, it might be time to dig deeper before hitting buy. Let's say you bought a tech stock because it was trending or someone on social media hyped it. That's not understanding, that's gambling. Peter Lynch investing strategies were always based on knowing the fundamentals, what the company produces, who its customers are, and how it stacks up against competitors. When you understand what you own, you're less likely to panic during stock price drops or periods of market volatility. Knowledge brings confidence, and confidence is your anchor when the market gets rough. This principle is also crucial when evaluating long-term stock investing or choosing between bonds versus stocks. If you blindly pick assets without clarity, you're more vulnerable to emotional decisions. Want to improve? Read company reports, follow earnings calls, and keep an eye on industry trends. Books like One Up on Wall Street are a great place to start. The goal isn't to become a Wall Street analyst, it's to avoid being the last person to know why your stock just tanked. Market corrections are like surprise storms. You never know exactly when they'll hit, but you can prepare for them. The first step is adjusting your mindset. A 10-20 dip in the stock market isn't the apocalypse, it's part of the game. Peter Lynch often reminded investors not to let fear dictate their moves. Understanding stocks includes knowing that downturns are temporary, and often they're buying opportunities in disguise. The more you panic, the more likely you are to sell low and regret it later. Think of a correction as the market's way of catching its breath. Stock price drops might seem alarming on the surface, but they don't always reflect the real value of a business. Take a moment and ask, has the company's long-term potential really changed? Or is this just a wave of volatility? Stock market advice from seasoned investors often boils down to one word during a correction: patience. When you've done your homework, you can ride the wave instead of getting wiped out. The key is to develop investing strategies that are built for resilience. That might mean diversifying, holding some cash for unexpected dips, or rebalancing between bonds versus stocks. Market downturns don't have to be scary if you know what you own and why you own it. Think long-term, stay calm, and don't confuse movement with progress. Now, let's look at one of the silent players that tends to show up at the worst moments: debt. Debt can be like a double-edged sword in the world of investing. Used wisely, it can leverage opportunities. Used recklessly, it can destroy a portfolio. When market downturns hit, high levels of debt tend to amplify losses. Investors with borrowed money are often forced to sell at the worst possible time, just to meet margin calls or cover obligations. That's why Peter Lynch warned against overextending yourself. In volatile times, the safest place to be is in control of your own capital. Imagine this: you buy stocks using borrowed funds, thinking you'll double your money. Then a correction hits. Stock price drops by 15, and suddenly your position is underwater. Now you're not just losing money, you're in debt too. That kind of stress can trigger rush decisions and panic selling. Investing strategies should always factor in your debt levels. If you're deep in credit card debt or paying off high-interest loans, maybe it's not the best moment to dive headfirst into the stock market. Instead of rushing, focus on building a strong financial base. Paying off bad debt is often a better investment than trying to time the market. Financial wisdom means knowing when to play offense and when to defend. A solid approach to long-term stock investing starts with financial stability. You can't ride out market volatility if your personal finances are already shaky. So, before asking, "What should I buy?" maybe the real question is, should I be buying at all right now? Peter Lynch didn't believe in trying to predict exactly when the market would fall, but he did believe in being ready when it did. Instead of obsessing over perfect timing, he focused on preparation. Timing the market is almost impossible, even for the professionals. But recognizing value during dips, that's a skill anyone can learn. When stocks drop, it's not always a warning sign. Sometimes it's a clearance sale for the smart investor who knows what to look for. One of Lynch's golden rules was to invest in what you understand and buy when prices fall without panicking. Let's say a solid company, one you've researched thoroughly, drops 20 during a market correction. Most people run for the hills, but someone using Peter Lynch investing principles might see it as a gift. That's why understanding stocks is so important. If you know the business is still strong, a lower price just means a better deal. Fear creates opportunity for the well-prepared. But don't confuse activity with strategy. Buying opportunities during market downturns are only valuable if you have the cash and courage to act. That means building your watch list in advance, keeping some liquidity, and avoiding the trap of chasing trends. Peter Lynch's advice was simple but powerful. The best time to buy isn't when everyone is celebrating. It's when everyone is running scared. And that leads us to an important warning. Not every stock that falls is worth catching. It's easy to fall into the trap of thinking a lower price means a better deal, but that's not always the case. Just because a stock has dropped 30 doesn't make it a bargain. As Peter Lynch famously said, a stock is not a lottery ticket. If the fundamentals are weak, a falling price could signal deeper problems. Understanding stocks means looking beyond the surface. Price alone is just one piece of the puzzle, not the full story. Picture this: a trendy tech company's stock crashes after earnings disappoint. Investors rush in, thinking they've found a steal. But if the company's debt is piling up, growth is slowing, and management is a mess, the deal might just be a money pit. Stock Market Advice 101: do your homework. Market volatility can create buying opportunities, but only for businesses that actually have value behind the ticker. Falling knives don't just hurt, they bleed portfolios dry. Instead of getting dazzled by the discount, ask smarter questions. Is the business model still strong? Are earnings stable? What's the long-term outlook? Financial wisdom means resisting the urge to buy just because something looks cheap. Remember, Peter Lynch didn't chase price drops, he chased quality at a good value. And when you spot that combination, especially during a correction, you've got a real opportunity on your hands. Speaking of which, how do you actually take advantage of those moments? Market declines aren't the enemy, they're an invitation. When fear drives prices down, investors who stay calm can spot golden opportunities. Peter Lynch investing wasn't about avoiding downturns, it was about using them to your advantage. While others sell in a panic, the wise investor watches and waits. This is where market corrections can become moments of growth, not loss if you've done your research and kept a long-term mindset. Start by building a watch list of companies you truly understand, businesses with strong fundamentals, solid leadership, and clear growth potential. When the next dip hits, you won't be scrambling, you'll be ready. Think of it like shopping with a list during a massive sale. Instead of randomly grabbing everything marked down, you pick only what you need and trust. That's the kind of discipline that separates investors from gamblers during stock price drops. Also, don't underestimate the power of patience. You don't have to catch the bottom to come out ahead. Even if you buy halfway down, quality stocks tend to bounce back in the long run. Long-term stock investing is about confidence and consistency, not chasing perfection. So next time the market trembles and headlines scream, "Crisis," take a breath. That dip might just be your best buying opportunity yet. And it's exactly the kind of moment Peter Lynch would lean into. Peter Lynch was crystal clear on one thing over the long haul: stocks outperform bonds. While bonds offer stability, they rarely deliver the kind of growth that builds real wealth. Lynch saw stocks as dynamic, full of potential, and reflective of business innovation. Bonds, in contrast, were fixed income and often fixed in mediocrity. For anyone serious about growth investing strategies, equities were the way forward, even if they came with some bumps along the way. Let's break it down. Bonds might seem safer, especially during market volatility, but their returns are usually limited to a few percentage points. Stocks, on the other hand, represent ownership in companies that can double, triple, or even 10x your investment. Peter Lynch wasn't against bonds entirely, but he believed they were best for preserving wealth, not multiplying it. If you're young, have time, and want to build capital, the stock market is where the magic happens. Of course, this doesn't mean ignoring risk. The key is understanding stocks, not just holding them blindly. Use smart investing strategies, diversify your portfolio, and remember that not every stock is a winner. But over decades, the odds are in your favor. As Lynch put it, the real key to making money in stocks is not to get scared out of them. That's the kind of financial wisdom that keeps your eyes on the prize through every correction, every dip, every headline. As we wrap up, think about this: you don't need to be a financial genius to succeed in the stock market. With Peter Lynch's approach, understanding what you own, waiting for the right moments, and sticking to sound strategies, you can build wealth over the long term. The key is patience and discipline. Don't let fear or market noise distract you from your goals. Are you ready to start investing smarter? To take what you've learned and apply it in your own financial journey? The next time a market downturn hits, instead of panicking, you'll be prepared to seize the opportunity. And remember, the journey of building wealth is a marathon, not a sprint. If you found this insight valuable, don't forget to hit that subscribe button and turn on notifications. You won't want to miss out on more tips and strategies that will help you navigate the ever-changing world of investing. Let's keep growing together, one smart decision at a time.